Investors and traders, this video will combine other technical and sentiment indicators with Commodity Channel Index, CCI Indicator, to give a multiple rule-based strategies. This video will not give basic definitions of the CCI indicator, but will build multiple strategies that will take away the uncertainty of investing or trading. In my own trading system, I have over 100 indicators to build a weight of evidence to time the overall market, sectors, and individual securities. These are some of the indicators to start you on your way to build a profitable trading system. You know the catchphrase: study it, analyze it, adapt it. Strategy 1: CCI indicator combined with the VIX and the VXN. Rule 1: extreme overbought or oversold levels on the CCI Commodity Channel Index indicator. We are going to wait for the CCI to hit an extreme level. Then we are going to look to take a reversal trade in the opposite direction. Overbought or oversold levels are not fixed since the indicator is unbound. Therefore, traders look at the past readings on the indicator to get a sense of where the price reversed. For one stock, it may tend to reverse near plus 200 and minus 150. Another commodity, security, asset, overall market, meanwhile, may tend to reverse near plus 325 and minus 350. More volatile markets will have a greater thresholds. It is not uncommon for stocks to have thresholds at plus or minus 200. Again, CCI is an unbound indicator, meaning it can go higher or lower indefinitely. Usually it trades in the 150 to the minus 150 range. For this reason, overbought and oversold levels are typically determined for each individual asset by looking at historical extreme CCI levels where the price reversed from. I want to give a very high probability of trading, so extreme levels is the first step that we are looking for. We're going to wait for the CCI to hit that extreme level, and then we are going to look back to take a reversal trade in the opposite direction. Just a key point is, don't fight the overall trend of the market. If the overall trend of the market is bullish, this is the direction that we want to take. If we are in a bull market, be cautious on the shorts, but extreme levels on oversold assets on the CCI buy. So the macro picture becomes very important. Rule 2: VIX, VXN rockets or drops to lower levels, yearly lows and multiple year lows. To simplify, the VIX and the VXN, it is really a way at looking at the market sentiment, how people are feeling about the market. Are people feeling scared? Are people feeling anxious? Or are the people not scared? Usually the masses are wrong. The more fear or the higher the VIX, the more opportunity it is to buy. Also, the lower VIX, the less opportunity to buy and more a place to take profits. Initial breakouts or breakdowns are the best places to get involved. We're not going over stop losses today, but of course on every system you should have stop losses. But by combining an extreme overbought to oversold level with the VIX and the VXN should bring you a very high probability of success. So let's go to the charts and let's see a few examples. Let's take the VIX and let's go back recently to August 12th. August 13th, you see a very recent low on the VIX. So let's just pick an arbitrary date, and it doesn't have to be exactly, but you could definitely tell the VIX was at a 4-month low, and the usual trading for the VIX is buy below 20 since December 2022 of this year, or 20,000 January of 2022 this year. That has been the usual mark. And let's just look over here. VIX goes to 20, and let's just pick the lowest date, but any day around that period. 8/12, 8/13, 8/11, 8/10. Let's go to the CCI indicator and go back to that date over there, 8/12, and the VIX works in opposite directions. So let's find the 8/12, 8/16. You see, and also 7/29. So the CCI was very high at this range, saying, wow, look how high this is over here. And then look what happens, straight down falling. This will also, let's go to another try, and let's go to over here. And this is 6/13. The VIX was very high. The VIX at a certain point, 32.30 was the usual range. So I'm going to go to 6/13. You could see the VIX was very high. Remember, the VIX works opposite the market. And then you go to the CCI. And let's go 6/13 and see where we are. 6/13, right there. And again, you could see the VIX, the CCI, very low. So again, you find periods of time when the CCI is at extremes, especially for the macro, spiders, QQQs, diamonds, and then you correlate it with the VIX. And as you can see, each and every time, it works out pretty well. So again, CCI reaches an extreme level. Look at the VIX. Has the VIX been trading at that range, or has a 3 or 6 month high or low? The correlation will be close to 95% winning trades. Do the research yourself. Check it out. Those are only 2 indicators that you're combining. You're not even combining 4 or 5 indicators, just 2 indicators. Study CCI, which we use 20 period, and we're using the VIX also. Strategy 2, CCI indicator combined with the MACD. Rule 1, follow top-down approach. The top-down approach to investing focuses on the big picture or how the overall market is trending. If the overall market is doing well, chances are the CCI indicator combined with MACD will also do well. What's the trend of the market? If it's negative, you'll want to do very little, if any, buying. Even if you see some stocks breaking out, your probabilities of success are quite low when the market trend is going against you. On the other hand, if the market is doing well, this combination of indicators back-tested has an amazing result. Case study. We will assume the overall market is bullish for this case study, but remember, we could be in a bear market. If in a bear market, in a real market investing, use the opposite rules. Rule 2. Commodity channel index indicator drops to lower levels, yearly lows, and multiple year lows. If we wait for the CCI reading that falls to a recent low, then we are going to look for a reversal trade in the opposite direction. Just because it fell to a recent low does not mean we buy, but it is an indication we could buy soon if other factors happen. So the CCI is the get ready to buy signal. So if the CCI falls to low levels, multi-year lows, or lower lows, then we proceed to Rule 3. Rule 3, MACD buy signal. MACD is more of an oscillator identifying key turning points. It does an excellent job at high points and lower points, but does not do a good job in a narrow range. When you get a buy signal for the MACD, it is time to enter. Sometimes I like to see a close above a day or a few day high for further combination. The MACD works great. You have low extremes on the CCI. And then as suddenly, when the MACD turns to a buy signal, it gives you a great indication. If you also couple this with, if you know if it's a bear or a bull market you're in, it gives you a great profit for yourself. Best results, initial breakout. Usually the first breakout being the strongest. Always on a lot of these indicators, the first move is the strongest move. Best results, CCI histogram positive. One of the CCI crosses above the zero line to positive, it is a further confirmation of the entry buy. CCI above zero indicates the price is above the historic average. When trading above zero, the current price is above its historical average. An emerging bullish trend would be going from a negative or near zero readings to 100 can be used as a signal of an uptrend. So CCI turning positive on the histogram is further confirmation of the buy signals. Best results: stay above 0 to 100, confirming a bullish trend. During a strong uptrend, the CCI will typically remain above the plus 100 level. Staying at higher levels confirms the strong trend and staying away from below zero readings. Exit strategy: protect the profits. This increased volatility in the stock market is a two-edged sword. On the positive side, it gives us a chance to make money even faster. The downside is that when a reversal occurs, your stock can drop more quickly. The exit strategy will keep your decision-making simple, objective, and unemotional. You also want to constantly rethink whether it's time to lock in your profit or cut your short your loss. This simplification of the selling process is more important than ever with the market becoming increasingly volatile. You don't want to suddenly sell a perfectly fine uptrending stop simply because of a whim. In more likely and happy circumstance that your stock starts to move higher, here's what to do. As long as the stock is above its rising 200-day M&A moving average and the moving average is rising in an uptrend fashion, be sure to give it plenty of room to gyrate with using ATR stop loss. We are going to trail the sell stop behind the advancing price. Risk management: stop losses. The first thing any good trader investor should do is realize that they must never hold any position without a protective stop loss. These issues can really change direction in a hurry when bad news comes out and institutional herd starts to panic. The way to protect yourself is by using stop orders. Using stop orders results in a minimum emotion and misgivings. Best of all, there will be no gut-wrenching decisions. The CCI is at lows, very lows, which tells us that we should be watching for a buy. And then it goes up to here. A MACD buy signal. Off to the races. Staying above the 200-day moving average. The line is definitely looking like an upswing. Here you might have gotten out of. Yeah, absolutely, for the stop loss. And then we continue up further from here and maybe a repurchase in. So again, CCI is a watch. Let's watch what's happening. Is it coming to new lows? Is it happening? The MACD, a signal to buy and to jump in. The trigger, pull the trigger. Then we watch some of the other signs. Don't forget also watching the CCI turning positive and use the average true range for a stop loss going back. We cannot finish by not speaking about Bitcoin. Let's just go back a little bit at Bitcoin. We look at here, CCI hitting lows, MACD buy signal. Throw out all the other signs, throw out. And we're off to the races, Strategy 3. Commodity Channel Index, CCI indicator, combined with insider transaction information. Rule 1 we will keep as the other two. Look at the extremes. This time we're not concentrating on the macro, but we're concentrating on individual securities. So look at the extremes of individual securities on the CCI indicator on an unbound indicator. Rule 2, insider transaction. The legendary Fidelity investment manager Peter Lynch once said insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. Lynch, who grew the Fidelity Magellan Fund from 18 million to 14 billion in 13 years, was a believer in fundamental analysis and understanding a company's product and practices well before investing in them. As a group who understands company projects management and future process better than its own leaders, investors can capitalize on insider knowledge legally by following public databases that track insider buying. Indeed, some may say that tracking the buying and selling of activities of a company's insiders is an integral part of due diligence when investing in companies. Here's how to do it. The SEC's EDGAR database allows free public access to all filing related to insider buying and selling of stock shares. A number of financial information websites offer easy-to-use databases of insider buying. What does it mean when insiders buy or sell? As a general rule, insiders buying shows management confidence in the company and is considered a bullish sign. In other words, the insiders think their stock price is likely to go up. Insider selling is considered bearish. Those in the know may be offloading their stock in an expectation that price will fall soon. So imagine this. CCI is at extreme lows. You go and you track the ratio of sells to buys of insiders, and you see it is a very positive and bullish movement of insiders buying stocks. They are registering the stocks with the government before they sell or before they buy. So this will be a great indicator of using CCI and a news-driven insider information. 2003 study by Harvard University Leslie A. Jang and Richard Zeckhauser and Yale University Andrew Metrick found that insider purchases beat the market by 11.2% per year. Notably, insider sales were not comparable profitable. That's why many investors keep an eye on the activities of insiders. Strategy 4. Rule 1. Again, CCI indicator at extremes. But this time, we'll be combining it with another system, the RMO. The RMO, Rahul Mahinder Oscillator, which was developed by guess who? Rahul Mahinder. The RMO is a rule-based module offered on Metastock with the standard version and many other charting software. Some key takeaways of the RMO. It is a system-driven approach with no emotion needed to trade, just the rules. It's an awesome concept. There are 3 indicators in the RMO and with the CCI that makes it 4. RMO gives the primary trend. RMO is below or above 0. Above 0 bullish, below 0 bearish. Is a primer longer term trend. Swing trade 2 is a short term trend, and a swing trade 3 is a medium term trend. When all 3 are in one direction, it is all bullish or bearish, with the first breakout being the strongest. Key takeaways. I specifically like to trade in the direction of the dominant market. I look to see is the macro bullish or bearish with many other indicators, and then combining that with these CCI indicators combined with other indicators give a very high probability chance of winning. So it's really combining a lot of indicators with weighted evidence to see which direction the market's going to, which sectors are going well, and then breaking it down into the individual stocks. The rules on the macro picture will take some time to learn, but it is so important. And the CCI indicator in itself can give you many ways to look at the macro, especially if the CCI indicator is trading from 0 to, let's say, 100 or 100 to 200. In that range, it is predominantly a bull market. 0 to minus 100 to minus 200, unbound indicator can go as low as possible, but trading in a lower range is usually a bearish market. So that's another way you can combine the CC indicator with some of the other ones. Remember, CCI most of the time is a lookout to buy. It's not the trigger. Also, initial breakouts is the best time to start with the CCI and this system. Protect your profits and always use stop losses. You know what I'm going to say? Study it, analyze it, adapt it, and use the CCI indicator in your trading system.